Welcome to this explainer. Okay, so you've just made the massive leap from renter to owner. Congratulations. But you've probably realized by now that owning a home comes with a seriously steep learning curve, right? And don't even get me started on the mountain of truly confusing mail. Suddenly you're getting all these official-looking notices you've never seen before? Well, today we're going to completely demystify the often confusing world of mortgage escrow accounts. We're going to take all that overwhelming paperwork and turn it into clear, actionable knowledge you can actually use.
So, picture this. You open your monthly mortgage statement and notice that your payment amount actually changed. It's incredibly frustrating, isn't it? Especially when you, specifically, purposefully signed up for a fixed-rate loan. You think, hey, a fixed rate means a fixed monthly bill forever, right? Well, not exactly. That suddenly fluctuating number is exactly what we're going to unravel today. Because the main culprit behind this, ironically, changing math, is a small, super misunderstood tool called an escrow account. All right, here's our quick roadmap for today. 1. The escrow mystery. 2. Inside the escrow bucket. 3. Doing the escrow math. 4. The annual escrow analysis. 5. Pros, cons, and myths. And 6. Key homeowner takeaways. Let's dive right in.
Section 1. The escrow mystery. Defining the holding pen.
At its absolute simplest, an escrow account, which, by the way, you might sometimes hear called an impound account, is essentially just a dedicated savings account. Think of it like a financial holding pen for your money. Or actually, you know what? It's really more like an adult piggy bank that your bank strictly manages for you. Instead of you frantically checking the couch cushions every December to pay these massive, once-a-year tax bills out of pocket, your lender just automatically collects a little portion of that money every single month as part of your regular mortgage payment. They hold on to it securely, and then they pay those big bills for you right when they come due. Ultimately, it's a system built entirely on protection. It protects you from falling behind on your bills, and it protects the lender's valuable collateral, your house. Moving on to Section 2. Inside the escrow bucket, what goes in and out?
So, what exactly is sitting inside this adult piggy bank? Well, there are a few critical bills funded directly through this account. First up, your property taxes, which fund your local schools and community services. Lenders absolutely require this because, look, if you don't pay your taxes, the government could literally put a tax lien on your home, and the bank definitely doesn't want that. Next is homeowners insurance. This protects the property from catastrophic damage like fires. Again, the lender desperately needs this paid so their collateral doesn't literally go up in smoke. You're also going to see mortgage insurance, or PMI, in this bucket if you put less than 20% down when you bought the place. And finally, if you live in a high-risk weather area, your flood insurance will likely be required and escrowed right here too.
Now, it is absolutely crucial for first-time buyers who are setting up their household budgets to understand the strict boundaries of this bucket. Because while your heavy hitters, like local taxes and property insurance, are safely covered, you are still entirely responsible for the rest of your homeownership costs. Your escrow account will never, ever pay your monthly water, electricity, or gas bills, and it certainly won't pay your homeowners association or HOA dues. Those are entirely separate checks you need to remember to write every single month. Basically, don't fall into the trap of thinking your mortgage payment covers absolutely everything attached to the house. It definitely doesn't.
Section 3. Doing the escrow math. Calculating your monthly bill. Okay, let's actually do some quick back-of-the-napkin math to see how your servicer comes up with these numbers. To figure out your monthly escrow contribution, your lender takes the estimated total of your annual bills and simply divides it by 12. It's that simple. Let's imagine your property taxes are $2,400 a year, and your homeowner's insurance is $1,200 a year. That's a combined total of $3,600. Divide that $3,600 by 12 months, and boom, it equals a clean, highly predictable $300 per month added seamlessly to your mortgage payment.
But, there's a vital catch here, and it catches a lot of new homeowners totally off guard. Federal law actually allows lenders to keep a cushion in your escrow account. This is typically up to 2 months' worth of extra payments. Now, why on earth do they hold on to more of your cash than they seemingly need? Well, it acts as a legal safeguard. You see, property taxes and insurance premiums are notorious for jumping up completely unexpectedly from year to year. It's a huge pain point for homeowners. This cushion ensures that if those rates suddenly spike, your escrow account doesn't hit zero and accidentally bounce a vital payment to your insurance company or the local tax collector.
Section 4. The annual escrow analysis. Balancing the books. So once a year, your lender looks at the past year's bills and projects next year's costs. You're going to get an annual escrow disclosure statement in the mail, and this is going to leave you with one of two possible outcomes.
First, if your bills were somehow lower than expected, you have a surplus. And if that surplus is over $50, the lender will usually send you a really nice unexpected refund check. We love those. But if your local taxes or insurance rates went up, you have a shortage. To fix a shortage, you usually have the option to either pay the difference in one upfront lump sum, or, and this is exactly why your payment mysteriously changes, you can have the lender spread that shortage out over the next 12 months. Naturally, that increases your monthly mortgage payment.
Section 5. Pros, cons, and myths, weighing your options.
When you're weighing your options regarding this whole system, the absolute biggest pro is massive convenience. You make one single payment every month instead of tracking multiple, super stressful due dates throughout the year. You also completely avoid what I call the holiday blues, meaning you aren't getting hit with a massive multi-thousand-dollar tax bill right around December when finances are usually pretty tight anyway. Plus, some lenders will even offer slightly lower interest rates if you agree to use an escrow account. However, on the flip side, you've got tied-up funds. Remember that 2-month extra cushion we talked about? Well, that cash stays in the bank's account, not your own personal savings account where it could be earning you interest. Furthermore, when you first buy the house, you often have to pony up some upfront cash at closing just to initially fund those first few months of the bucket.
Now, let's firmly bust a couple of major misconceptions that cause folks way too much unnecessary anxiety. Myth number 1, hey, my mortgage payment is fixed, so it shouldn't ever change. The reality, while your loan's actual interest rate is indeed set in stone, your escrow costs are absolutely going to fluctuate as local tax and insurance markets shift around you. Now for myth number 2, the bank secretly keeps my extra money to fund their wild corporate parties. Look, totally not true. By federal law, those are strictly your funds. If there's a surplus at the end of the annual analysis and your regular loan payments are current, regulations dictate that the extra money must be returned right back to you.
Section 6. Key homeowner takeaways. Taking control.
All right, here are your 3 actionable steps to become a truly proactive homeowner. Step 1. When that annual escrow disclosure statement arrives, whatever you do, don't just blindly file it away unread. Open it up, review the numbers, and see exactly what triggered your shortage or surplus. Step 2. Aggressively shop for better insurance rates. Seriously, if you notice your premium just spiked, causing a shortage, shopping around for a new insurance policy is a proven, highly effective way to take your power back and actually lower your total monthly mortgage payment. Step 3. Plan for changes. If your local town recently passed new school bonds or municipal budgets, you should fully expect your property taxes and therefore your escrow payment to follow suit.
So, to summarize our educational journey today, this seemingly complicated black box that intimidates so many new buyers is, in reality, just a logical, required tool. Escrow is simply a dedicated holding account designed to protect both you and the bank. Your overall payment changes strictly because the underlying costs of your taxes and insurance change, not the terms of the loan itself. And finally, that annual analysis we talked about? That's the vital mechanism that keeps the entire system perfectly balanced over time, ensuring you never pay too much or too little over the entire life of your loan. The mystery of the fluctuating fixed-rate payment is completely solved.
Now that you have the knowledge, the power is totally in your hands. Are you ready to confidently open your next mortgage statement? Seriously, ask yourself, who is really in control of your monthly payment, your bank or your local tax assessor? Taking control of your finances starts with completely removing the mystery from the equation. I really hope this explainer has given you the exact tools you need to be a savvy, empowered homeowner. Keep learning, keep analyzing those statements, and most importantly, stay focused out there.